So, all right, welcome to this installment of Olin's Ownership Insights interview series in support of the Koch Center for Family Business and our Learn.WashU online learning community. I'm Professor Rich Ryffel, a professor of finance practice here at the Olin Business School and an advisor to the Koch Center. And joining me today is Josh Barron. Josh is the founder of Banyan Global, a consulting firm which works with the leaders of family businesses to help them define their purpose as owners. He's the author of the Harvard Business Review's Family Business Handbook, which I have here. Can't see that too well. It's a little blurry, but it's also behind you in great number there, Josh, I see, strategically positioned.
Storage, really. But yeah.
Storage, okay. And Josh is also an adjunct lecturer at both Columbia and Harvard. So welcome, Josh. Thanks for being my guest today.
Thanks. Great to be here. Appreciate having me.
So, Josh, I know in our prep, we talked about a few topics that I wanted to hit, but I want to kind of have a wide-ranging conversation that'll stretch you to talk about various parts of your book and maybe give me also some observations from what you're seeing with some of your current clients today.
That's great.
We have at WashU and at Olin sort of a unique and growing focus on family business through the Koch Center, through our Ownership's Insight course. And that's somewhat unique. I'm sure you work with a number of universities, and not all of them do focus on that. And so it's a little bit of a neglected area that you've, made your life's work and your passion. So we love to see that this is sort of increasing across some other schools. And we're pretty proud of the work that we're doing. But one of the things I see in teaching my students, many MBAs, many graduate finance students, is that for the most part, if I were to generalize, they come to business school and they're hoping to get an education and kind of polish up their resume and whatnot, and then go out and work for larger, high profile, usually publicly held companies as opposed to smaller, maybe family-owned businesses. So for the benefit of students that might have come to Olin thinking, I'm going to go work for McKinsey or Goldman Sachs or maybe a fintech startup, why don't you tell us a little bit about, how you've seen the difference between family business privately held versus publicly held, and what that might mean to someone just starting out a career and looking to apply some of the skills they got at a great place like WashU?
Yeah, that's a great question. And, it's interesting. Family businesses, by most stats, make up a majority of the economy, majority of jobs. They're not the places you said that we tend to focus on in business school so much, but they can be pretty extraordinary places to work. And not just sort of small. We tend to think of family businesses as small, but there are some extraordinarily, well-known and large family businesses as well. So definitely something for folks to be keeping an eye on. Look, I think it all kind of, to me, what really separates family businesses from publicly traded companies, widely held companies, is really this idea of ownership. And my observation is that we don't really teach so much about ownership in business school. We teach a lot of, management practice and finance, accounting, those skills. We teach a little bit of corporate governance, but we don't really talk too much about this idea of what it means to be the owner of a company. And I think it goes back to kind of what you were saying, that the orientation of most business school programs, both of the students looking for jobs, the faculty doing research, is for a variety of reasons, focusing on these widely held public companies where to be an owner doesn't really mean very much. You're an investor. You're kind of trying to buy low and sell high. You can go to the annual meeting or sign a proxy statement. I've never done any of those things for the public companies that I've invested in. But family businesses are very different. I always tell people, think about like something you own personally, like a house or a car. What does it mean to be the owner of those things? And well, what it really means is that you get to make choices and do things that no one else can do unless you give them permission. If it's your house, you get to decide everything from like what color to paint it to like, can the in-laws come visit next week, to do I keep it or sell it, and sort of all this kind of stuff in between. And that's what it means really when you're talking about a family business, is that you have a relatively small group of relatives. usually, maybe less than 10, no, sometimes even a few hundred. They all know each other. And the vast majority of their wealth, in most cases, is instead of being diversified across hundreds or thousands of companies and mutual funds, it might be 90% of their wealth is concentrated in this particular business, right? So they both have a lot of power, the ability to make all kinds of different choices, as well as a lot of focus and interest, because how this particular business plays out has a lot to do with both their economic lives, their social lives, and sort of everything, because family businesses tend to be sort of very encompassing. And so if you sort of take that broader view, what tends to be different are a whole bunch of things as a result of that. When I used to work at Bain & Company early in my career, we never had to ask our clients, who were mostly publicly traded companies, how they measured success of our work. It was always the same answer. It was, what's going to increase the total shareholder returns or up the stock price. In a family business, that's, it's not necessarily that. Financial returns are important. You can't stay in business if you don't do well financially. But oftentimes there's a whole host of things that are equally or sometimes even more important to the family that might come from their values or their community, other things like that. Family businesses take a very different view about employment. They tend to have people who are there for a very long time. That's true of CEO tenures. That's true of just people. The average employee tenure tends to be quite a lot longer. They tend to have different views on the community and sort of being engaged and participating. So it's a whole host of things it's really a different form of capitalism almost in my view. And it can be pretty extraordinary, something that creates these companies that have been around for centuries and doing great work in the community, or they can be the things that blow up, like you see in sort of the dramas like Succession and Dynasty, Dallas, Yellowstone. There's a whole genre of like family business feuding stories, and it can be sort of either of those streams. It's really quite a bit different.
That you've given us a lot there. There's a lot to unpack. So I'll just make a couple of comments about what you mentioned here. Some great sound bites. You said a lot of people confuse family business with small business, and that's anything but the case. You look at some of the great privately held family-owned companies that are global and have been around for 100 years and have thousands of employees. Yeah. So, not to confuse mom and pop with family. Mom and pop are just a small part of most families.
That's right.
So an important distinction. And then I'm going to give you an analogy that maybe will resonate on this shareholder versus owner point. You mentioned owning your house. But think of that as I have complete unilateral control over how I paint my house, what color I paint it, whether I cut the lawn and whatnot. I would not have that same unilateralism if I owned a condo, where I would have others in my HOA.
Sure.
So, a family business with concentrated ownership is maybe more like owning a house, where a publicly held company is more like owning a condo. And from what I know of a lot of condo and co-op associations, they have just as much drama as Succession, Dynasty, Dallas, and Yellowstone
well, that's for sure.
as well. So, and then the other thing you mentioned, referencing your experience at Bain, I just love this point, because I teach a session in my financial markets class on ESG and corporate social responsibility, and we talk about the purpose of a corporation going all the way back to Milton Friedman. And his encyclical in 1970, is very clear. The role of a corporation is to maximize shareholder value and increase shareholder return. And so you've touched on something very interesting here. And I think a lot of family-owned businesses are leaders in this. As we move towards more CSR, where we now have 5 stakeholders instead of one shareholder, shareholder being one of the 5 stakeholders, I think family businesses have long been able to take more of an interest in some of these other stakeholders, because they unilaterally control whether or not they're pleased with the financial returns. So some of these extra financial considerations that we're now seeing to creep in the business that are becoming quite controversial, whether you're Larry Fink or Vivek Ramaswamy or, on opposite sides of that. This is a fascinating topic. And I think family businesses can be trailblazers in this regard. So let's kind of pivot with those thoughts and give me your view on how specifically this difference of ownership versus investor, how does that change the way an owner, a family, interacts with the company day to day? So you talked a little bit about strategy and some of these considerations, but day to day, do you see some of these things creeping into the business that causes them to act in a way that's different maybe from a publicly held company?
All the time. Look, I think, family businesses have always probably been values driven, right? They've always been sort of driven by questions of legacy and longevity, which if you talk to someone in the finance world, will say, well, that company should only exist as long as it continues to be the best possible use of capital. That's not at all how a family business owner thinks about things. And that's you see that, for example, in how family businesses think about debt. It's totally different than how you sort of the optimal capital structure that you're taught in finance class. I was actually talking to a family business owner who had just done a week-long finance course at HBS, and we had lunch afterwards. And he said, I felt like an idiot all week because I'm being told I need to, increase my leverage to maximize my return on equity. He's like, we don't have any debt in our company because we know that sounds great. When everything's going well and we can borrow money and so on, everyone loves to lend us money when we don't really need it. But when the crash comes in our business and we're going through a downturn, that's when no one's going to want to lend us money. And if we have too much debt, we're going to go out of business. And so these sort of, I would say, non-purely total shareholder return values, whether those are longevity, legacy, the community, the employees, all these kinds of things, I think, have always been the concern of family businesses. And what we see happening, at least in my view, is as the values of the family are evolving, so too are the priorities of the family business, right? Because as the family starts to care more about ESG or DEI or whatever the right focus is for that family, those values start to become directly affecting the business priorities, because the owners will say, well, that's great that we had a great return last year, but how did we do on treating our employees well during COVID? Or how did we do in terms of reducing our emissions to the environment? And they can actually have the ability to put those kinds of pressures on the company. And I see those kinds of things all the time. The other thing I think that is a little different is that very often things that we think of as trade-offs, like between profitability and sustainability, or profitability versus diversity and equity inclusion, often are really only trade-offs in the short term. There's one family I work with that's in a heavy manufacturing industry. There's no way they'll ever be carbon neutral, but they're very, very focused on their carbon emissions. And they just spent a huge amount of money, hundreds of millions of dollars, on improving, investing in their machinery, getting like everything, top end, modernization, all this kind of stuff. Did they do that because it was going to increase their financial returns 5-6 years from now when all those investments pay off? Yes. Did they do that because that would reduce their environmental emissions 5 or 6 years from now when all of this gets into it? Yes. Like, it wasn't actually a trade-off. It was the fact that as we take the longer time horizon that family businesses have at least the potential to work under, a lot of these things that are trade-offs, actually, you can make the business case for. It's just not a next quarter business case. It might be a next decade business case. And family business owners have the ability to treat their business more in that term and make different decisions that where some of these trade-offs, not all of them, but some of them start to melt away.
Yeah, I think you've raised a great point there on this short-termism versus long-term view and the quarterly earnings, because I certainly have seen in the course of my career, you have management at publicly held companies that might be turning over more frequently. So while they may know in their gut, they may even know mathematically that a given decision is the right one to make, even in the 5-year term, which isn't particularly long in business.
Yeah.
They know their paycheck depends on, some action today, whereas the principals or the owners of the company can wait for that pot of gold and for that initiative to be accretive. So I would imagine you run into a lot of your clients that have this kind of nonstop, omnipresent principal agent conflict where you have to sort of remind the professional management that, hey, notwithstanding your compensation package, here's what I'm thinking about long term. Do you find that to be the case?
Yeah, it can be, right? Because I think the principal agent problem, I mean, that's sort of like the thing that large public companies have been trying to solve, since the idea came about, and even before that, with mixed results. Like, I think the track record of corporate governance and executive pay plans and all that kind of stuff, I'm not sure how well it's actually performing on some of those things. It's improving, but it's a really hard problem to solve. The thing about family businesses is that they have some different dynamics to them than public companies. One reason is because quite often the principals are the agents. Like, you actually have family members who are in senior leadership positions, not always a CEO, but not uncommonly, even for very large companies, a CEO. And so you can have someone who is making decisions through that lens. And I've seen some really amazing examples of one of the people that I know well, he calls it his owner hammer. And he says, every now he's in a senior role in the company, and every now and then he has to break out his owner hammer and just say, we're not doing this. And the reason we're not doing it is because it might be the right short-term decision, but it's the wrong long-term decision. And so he has to occasionally course correct. And having the family members working in the company can be a source. It can cause other problems. I'm happy to get to those too. But it can actually be a mechanism for doing that. The other thing is that that trade-off is really, to me, a function of really focusing on it and creating the right incentive programs. I was working with one family business, and the executives were making some choices. Family really wasn't working there anymore, but they were kind of on the board and so on. The executives were making some choices that really weren't what the family wanted them to do, and it figured out that a lot of it was because they were being compensated on annual earnings, on EBITDA, right? They were sort of being paid on growing EBITDA, and the shareholders at the end of the day say, like, that's not really what we care about. What we care about is the long-term appreciation of the company. And so what they did is they just revamped the entire executive compensation system and said, we're going to pay you to do the things that we really want you to do, and we're going to compensate you very generously for doing those things and not for doing these other things. And so there's an opportunity to sort of make sure you take those broad-based objectives you have as a family ownership group and work with your management team, and often through the board, to try to come up with a compensation structure that gets everyone onto the same page. And I think that's very possible. It just requires a fair amount of work and conversation. But when you do it well, then everyone's kind of, the principal agent problem starts to not go away, but it becomes much more, much lessened.
I love these little vignettes you're outlining too, so keep them coming. I could see where it would be somewhat of a challenge to construct a plan for an executive where they're focused on the long run, when oftentimes those longer run goals are difficult to measure.
Sure.
Brand equity, for example, very hard to measure, as opposed to like market share or pricing power or something like that. That's tough. And I could
appreciation though. I mean, that's an example, like appreciate the value of the asset over a 5-10 year period, however you want to measure it. I mean, that's something I think there are ways. I agree with you. There are some that are hard, and there are some that are, are available.
I'm going to push back on you a little. There
Sure.
Definitely are some ways to measure it. My experience is that many, not all, many family businesses don't have a regular or scientific way of valuing their company.
Yes.
Maybe the
I agree
larger,
with you. There you go.
The larger, more sophisticated ones maybe do, or they have the enterprising investment banker that comes in and says, hey, your business is worth a 12 multiple, that's $1 billion. Why don't you think about running an auction?
Yeah.
And so that's their sort of, and those valuations are usually widely off the mark. But anyway, my experience has been that a lot of owners don't really fully understand what the company is worth at any one point in time, and may not even know what the critical levers are to drive that accretion that you mentioned that they're looking for. But
fair enough.
In any event, I wanted to come back to one point. You mentioned this client of yours, or this executive ed attendee that was talking about debt and having a debt aversion. So my my parents grew up during the Depression, and
Sure.
so they taught me, to be very conservative and budget well and plan, and maybe that's why I'm in the business that I'm in. But they were definitely debt averse. Don't buy something on credit and whatnot. And certainly the stakes are raised when you think about it in terms of what that person you were referencing, like, hey, if we take on too much debt and things are bad, we lose the whole company. So it's almost like binary for them, the sense of,
Yeah, sure.
of risk. So I'm wondering if you have any examples or counsel for those companies that might be debt averse because they view debt not as a fuel for growth. They view it more as a risk enhancer. It's creating more risk for their company. So I'm wondering, do you have any thoughts on that risk aversion being in tension with the fact that successful companies need to innovate, they need to compete in an ever globalizing, scaling way, and oftentimes that requires capital. And if you want to maintain control, equity financing is maybe not a great option. So I've thrown a lot out at you there.
I think it's a great question. I think, like many things in life, the extremes are probably not ultimately too helpful. And I think where I've seen families be successful is to not be afraid of debt, in the sense that there are certainly specific situations where it's really helpful, but also to understand that, yes, debt can be a great mechanism for growth, and it can be a company killer. I remember, like, Toys R Us is an example that sticks in my mind personally. I've got twin 10-year-olds, and I can tell you definitively that Toys R Us did not go out of business because kids don't like toys anymore. It's not even that kids don't like toy stores anymore. My kids we go to Toys R Us all the time. And what really happened was that they had too much debt after a few LBOs and all kinds of financing, the extreme version of it. And then the natural economic decline of retail stores really kind of hit them to a point where they weren't able to meet the burden. And that's more the thing I think you want to be careful about, is if you overextend too much, then it really can be the end of the company. And if this is your company, if this is 90% of your wealth and a lot of your identity and all that other non-financial stuff too, that sort of feels like a lot. And so I'll give you an example, a family I think that does this really well. I work with one family that they describe themselves as hating debt. And in fact, under normal conditions, they maintain a very sizable cash reserve. That is exactly the opposite of what you'd want to do from a purely optimizing your balance sheet kind of perspective. But they are in a cyclical business, and it's they know that there are going to be upturns and downturns, and they're in it for the long haul. And there have been a few times over the course of their history where they've gone all in, where they've made huge acquisitions, and they've borrowed a lot of money. And it's hard to sort of put those two together, but that's the thing that they actually don't do either. They both they don't really love debt. They don't use it on a day-to-day basis, but they use it for something that is, game changing, that is going to sort of really push the company to the next level. And then as soon as they're able to, they get it down to a reasonable level. And I've seen lots of examples of families that are actually able to find some middle ground. And I think there's a lot of health in that kind of an approach. Don't be afraid to use leverage as a tool to make a big bet that you've thought through quite well, where you really see this as an opportunity to take the business to another level. But be careful about using it too much or too long or for any other purposes, because there is a real risk that if enough things happen together, that could lead to the end of the company.
Well, you used a critical word there, tool. And I think you're absolutely right. If you view it as a tool to allow you to grow your business as opposed to a financial engineering technique,
exactly.
then totally appropriate. So let's, and by the way, you mentioned twins. I have twins of my own. They're 25 now. And I left a fair share of my income at Toys R Us and was known to wait in line before it opened to get the hot toy. And when you have twins, as you know, Josh, you can't just get one of them.
Absolutely
so it's two Lego Millennium Falcons that you need, not just one. So
there you go.
Toys R Us is loving families like us. So You alluded earlier to the role of family in the company, and there's a lot of research on this topic. Give me, like, without constraints, just give me any thoughts you have on professional management versus family management, and the conditions in which one is more appropriate than the Are there any kind of rules of thumb, to the extent that there are any, in this business of family businesses?
Yeah, and just like, I tend to just not, I prefer family versus non-family. I think family members can be very professional, as opposed to unprofessional, and that's a lot of what makes the difference, is when family members, are acting as you'd expect any manager to act in the business. Look, I think, there's some really good research that was done looking at manufacturing companies and best practices across industries and things like that. And one of the conclusions that came out of that was really one of the first studies I've seen that actually compared companies of different ownership types. And what they found was that family businesses were managed just about the same as any other company, with one exception: when they choose the manager based on primogeniture, basically eldest son is CEO. That's the one thing where it's demonstrably worse for family companies. And I think that's sort of just, I say that as a way to sort of get into this topic. My experience has been just like, the extremes not being a great place to be. When families either require and insist on having family members work in the business and be led by a family member, I don't think that works out so great overall. I also think when family businesses exclude family members just because they're family members from working in the company, I'm not sure that works out so well either. I think there's a middle ground that I think can be very effective. My experience certainly has been is that there's nothing better than a family business led by a competent family member, and there's nothing worse than a family business led by an incompetent family member. So there's a lot, if you do it the right way, there's a lot of things that family leadership can bring to the table that are ultimately very beneficial to the company, like relationships, multi-generational relationships with suppliers. I work with one family in the alcohol distribution industry. Their single biggest asset is a relationship they have with a major wine producer. Like, that is the single biggest thing that they would say is the reason how they've been able to grow the company and be successful. They are very careful about handing the relationship from one family member generation to the next family member generation. And there's, people like working for the owners of businesses as long as they're qualified. There's lots of benefits that can come from it. And at the same time, some of the worst fights that you'll see in families are about who gets which job, who gets which compensation, all those other kinds of things. So it's not whether it's good or bad. In my view, if you do it well, it's good. If you do it poorly, it's bad. And there's a lot of good experience about how do you sort of develop, family employment policies and sort of other mechanisms and tools to try to handle this question of family members working in the business effectively.
So that was a great answer. So thank you for that. So as in many things in life and in business, there's usually an arbiter of who's doing things well versus who's doing things poorly. And in the corporate world, the publicly held corporate world, the arbiter of that would ultimately be a board of directors and then shareholders through proxy and increasingly activist investors and whatnot. We don't have that same governance in a family owned business. So maybe if you could touch a little bit on the role of board governance, interaction of a board, outside board, with a privately held company management versus what you'd see in the publicly held world.
Yeah, it's a really important topic, and one of the things I've been really happy to see is more and more families who are taking this sort of question of corporate governance more seriously, because there's a lot to learn about how it can really help make a difference in the effective running and operations of the business. And as you said, it's unlike a public company which requires a board. All family businesses, almost without exception, have boards. It's just that they might never meet or have any substance to them. They may be just on paper. But I will say, and I'm really reluctant to use the term best practices, because I think how different families do different things, and some of them can be highly effective. And almost without exception, if anyone kind of points and says, well, here's our family, how our family does it, and it works really well, I can go find you a family that's been equally as successful doing the opposite thing. All that said, I think having, once your business gets, above a certain size, having a real board of directors, one that meets and does the stuff that boards are supposed to do, like thinking about CEO hiring and succession and compensation, about strategy, big decisions like mergers and acquisitions, keeping an oversight of the business, and having a mix of family and independent directors is about as close to a best practice as I feel comfortable saying, because having that kind of structure just has so many benefits to a family business. Everything from, if something happens to the CEO, who's just like, maybe it's the patriarch or matriarch of the company, of the family, but also the one who started the business, having a board can be sort of like an insurance policy where you actually have some continuity if something happens to that person, or maybe it's a third generation leader who's highly effective. A board can help to make really tough decisions about, like, okay, we have two siblings vying for the same role. Which of them is qualified? That's a really hard decision for family members. Maybe those are your children or niece and nephew or sibling to be able to make. But if you're able to leverage some outside, unbiased expertise, some, people that are respected and revered, if you get the right folks, that can make all the difference in dealing with these very tough issues. It helps to sort of make the dynamic in about board decisions totally different. Soften some of the family dynamics that can sort of be difficult, and gives you that more sort of substantive, you can use the word professional, but gives you that more of the vibe to it. So there are all kinds of benefits that come from good corporate governance. And I really advise family businesses to think about and really explore that if it's not something they have in place.
That role of the board you just outlined reminded me of, how many times you've answered the question, I love all of my children equally. In that scenario where you have to pick, one of 3 or 4 kids to run the business, that could be construed as, loving one more than the other. And so I could definitely see a group, a third party helping there. So great answers. And I'd be remiss if I didn't point out that much of what you're talking about today is a chapter in your book, which I've enjoyed, having read twice now. So a lot of really good actionable advice, and a lot of good stories and war stories that you've collected over the years that you bring to bear in the book. So one, and maybe this will be the last kind of big topic that I ask you to talk about. And don't mean to put you on the spot, but it's a big topic in your book, and it's this 4-room model that you talk about. I found that to be just that was like a light bulb moment for me. I just absolutely love it. And if you could tell our listeners a little bit about that, I'd appreciate it.
Yeah, it really builds on what we were just talking about, which is this whole concept of governance. And in the early days of any business, any founder-led business, and certainly in a family business, decision making is very kind of concentrated. It's sort of like, we may have a formal organization chart, but it's really much more like a hub and spokes, where kind of like all the information's going to the center, to that one, founder, CEO, controlling owner person. All the decisions are going out. And that structure has some pluses to it in terms of being able to make big decisions quickly and so on. But at some point, family businesses more broadly, outgrow the ability of any one person, no matter how smart they are, how talented they are, to make every single decision. You need to build up a structure for making decisions, and for doing the work that comes with a much more complicated business, a more complicated family. And that's really how the idea of the 4-room model kind of comes out of that need. And the sort of the analogy, we call it the 4 rooms, because just like in your home, you do different work in the kitchen, where it's about like making dinner, versus the living room, where it's about like, what are we watching on Netflix. In a family business, you have these different types of work. You have these different types of decisions that need to be made. And the 4 rooms are the 4 types of decisions. And there's the management room, which is where you run the business day to day. It's the CEO, the CFO, all the employees, like, all the people that are working day to day and running the business. Then you have the boardroom, which is what we were just talking about. The boardroom is the place where you choose the next CEO, you evaluate the performance of your senior executives. You think about the strategy. Where are we going over the next 3 to 5 years? The management room tends to be sort of like focused on the urgency of the day. The boardroom gives you a chance to take a step back and say, where is our business heading? What are the threats out there? What are the opportunities out there that we need to be paying attention to, making big decisions? Folks bring wisdom of having been ex-CEOs or playing senior roles in companies for 30 years. Should we make that acquisition or not? It's a big bet. How do we bring in some outside expertise? And then you have the owner room, and the role of the owners in the owner room is to make a relatively small number of extremely important decisions. There are things like, should we sell the business? Should we take it public or keep it private? Who should sit on the board, and represent our interests? Are there certain things that we won't do, even though they might make us money? There's a family I know in the chemical industry. They can make a lot of profits selling to cigarette manufacturing businesses, but they decided that they're not going to do that because it's against their values. That's the kind of decision that only an owner can do, is to take something off the table, not for economic reasons, but for values or other reasons. And that those 3 rooms, as we describe it, are a hierarchy. Management ultimately is selected by and answers to the board. The board ultimately is answers to and selected by the owners. And that's the way those 3 rooms work. And then we have the 4th room, which is the family room. And we put that room on the side of the other 3 for a couple reasons. One is that the role of the family room is not to make business decisions. That's sort of in those other 3, depending on what decision we're talking about. But it is one of its roles is actually to develop talent that can go into, you're preparing the future owners, maybe the future board directors, the future managers of the company. So it's a talent development function. It's a place of building family unity, which happens very naturally in the early, first, second generation. But as we're talking about cousins and second and third cousins, as we get to 4th and 5th generation family businesses, there's a lot of energy and attention that's needed to trying to keep those relationships going. And then sometimes there are non-business assets that are of high importance to the family, even though they might not be as worth as much, like a family vacation home or a family foundation or something like that. And those are things that maybe are sitting in the family room as a place to manage them. And those are things that can be a wonderful way to build connections and relationships. And they can also be an incredible source of conflict. And some of the worst conflicts I've seen are about things like vacation homes and foundations. So having the family room be the place where you're providing some governance and rules and so on to the table. And so, the idea of the 4 rooms is that all of them are important. And, if you don't have any of those in place, then the entire system isn't going to work. It's like having a house without a kitchen. Like, it's not going to work so well. We need each of those rooms to be in place. It doesn't mean that you need a super complicated governance structure. Sometimes it's as simple as saying, okay, we're going to have a board meeting, and here's the agenda, and here's how we're going to make decisions. And every couple times a year, we're going to have an owner meeting, and this is how we're going to do this work together, or a family meeting. And just going through the process of saying, like, are we having those meetings and conversations? Who should be in the room for each one? How do we make decisions? And it might be different. In the management room, I might be the CEO, but maybe you and I are equal owners. And so in the management room, I'm the boss, but in the owner room, we're equals. And so just a very simple mechanism of going through those different functions and sort of organizing yourself is really helpful. As the family gets larger, business gets larger, then putting in place different governance structures like a family council, owner council, board of directors, and so on becomes really important to try to keep this whole thing running and accomplishing all the great things we want family businesses to do.
Great. That was a wonderful explanation. And you're a master at using household analogies. So that's wonderful. We have the house, we have the 4 rooms. Right? And yeah. What I love about that 4-room structure is it's a wonderful, simple rubric that anybody can use and apply to their business to kind of measure their progress on each of those. Your family room reminded me of a comment I heard the patriarch of a large 100-year-old family-owned business say the other day. They said, we're not so much in a family business as a family in business.
Yeah.
And that just really resonated with me, because that speaks to the importance of that family room to sort of infuse these other and I'm also envisioning everybody arguing over who's going to get Christmas week at the house in Breckenridge. You know, that's like more important than business strategy is,
Often,
you know, can I get that? So,
yeah.
Well, as we come to the end of our time here, I like to ask all of my guests if there's anything that they'd like to impart upon students or many of the practitioners that we'll have listening to this broadcast, anything at all that I haven't asked you that, you know, you think the world can't do without hearing here in the last few minutes we have together.
I don't have anything that meets that description, but I will say I was speaking at another business school, not either of the ones that I've taught at, and I remember one of the career people saying, "Why would anyone go work at their family business? Like they can go work at, you know, our students can go work at Goldman Sachs or McKinsey or whatever." And I think a couple things that I just, you know, given the population we're talking to. Look, it can be a really challenging thing, and I'm not going to understate it because I see this all the time, to work in your family's business. But it can be an extraordinary place. The kind of, you know, I was talking to one woman who left Google, a great job at Google, to go, you know, ultimately run her family business. And she said, look, no matter, you know, how successful I am at Google, you know, I'm not going to have the kind of impact that I'm going to be able to have on my family business, the employees that are there, you know, my future generations and so on. And the kind of influence to be able to change the direction of that, whether she ultimately became a CEO or not, is really quite extraordinary. And so just to sort of think about, you know, there's a lot of negativity I find about family businesses. Those are the only stories we tell in the popular press for the most part, are the Successions and Yellowstones and the real life ones too, the Sacklers and so on. There are so many positive stories about family businesses that just don't make the news. They're not newsworthy in that sense, but they can be extraordinary careers. And the same thing is true for non-family managers. I had a CEO of a family business come in one time, very, you know, multi-billion-dollar company, very successful, and he was asked the question, like, how do you compete for talent when, you know, other people are offering stock options and you can't? He said, you know, we're not for everyone. Like, there's certain people, like, you know, if that's what you want, or stock options, like, don't come work here. But there's a lot of other things we can offer. And what we do is we play to our strengths. You know, it can be an amazing place to work. You get to work with the owners of these businesses. You get to be able to think long term and bring your energy to things, and be with an employee, you know, an employer that probably cares more about the long term than, and not going to fire you as soon as the market takes a downturn, kind of thing. So I think just to realize that there can be some, and I've met these people that have had these, you know, multi-decade careers working for family businesses, and the way that they talk about that is really just extraordinary. So I think the one thing I'd like to just focus on is we tend to talk a lot about the negativity and the failure rates and all that kind of stuff about family businesses. And I'm not trying to take away from the fact that it's hard, but there are some really positive, amazing things that can happen, whether you're a member of a family or not, in sort of choosing this as your career.
Well, thank you for that. And I just by way of a quick story, I have a student that recently left a very large publicly held company here in St. Louis to go to a fairly small family-owned business. And the reason he cited was impact. And I think increasingly with younger generations, they're looking for satisfaction, continuity, maybe better work-life balance, maybe a longer-term view toward their career, and impact. And I agree with you that family-owned businesses do offer that opportunity. Josh Barron with Banyan Global, just been wonderful spending this time with you. Thanks for your time. Thanks for your insights. And thanks for caring to spend some time with our Olin students.
It was my pleasure. Thanks for inviting me.